The geopolitical competition has intensified in recent years, with shifts among leading economic powers. The United Kingdom is developing strategies to strengthen its relationship with China amidst trade and security challenges. Simultaneously, the United States is increasing technology control measures, targeting China's semiconductor industry to curb its technological ambitions. China has withdrawn from U.S. public debt, signaling resistance in the economic rivalry. These developments reshape the global order and create challenges for countries balancing economic interests and long-term strategies. The global economic battle continues. The West is reevaluating its 2025 strategic direction. Former U.S. President Donald Trump prepared for a new trade conflict with China. The European Union maintains a firm stance against cooperation with Beijing, but countries like the United Kingdom, Italy, and Spain recognize the necessity of engaging with China for economic stability. This shift contrasts previous tensions between Western leaders and Chinese President Xi Jinping at the G20 summit over human rights. The UK's attitude towards Beijing has transformed from a hardline stance to pursuing closer ties. The British Prime Minister was expected to visit Beijing in January, and the Finance Minister worked to foster deeper economic relations. This shift is influenced by the impact of Trump's global trade policies, including tariffs and pressure on Europe to increase U.S. oil and gas purchases. These policies cause economic strain, and the EU is concerned the UK could be the next target. UK Labour Party leader Keir Starmer recognizes the negative impact of tariffs and emphasizes maintaining sustainable trade with the EU, the UK's largest trading partner. Over 42% of UK exports go to the EU, and over 50% of UK imports come from the bloc, highlighting their interdependence. However, the EU faces challenges, particularly importing costly U.S. energy, which increases production costs and creates economic difficulties. The UK faces dual pressure, importing expensive energy and maintaining export competitiveness in a weakened EU market. Brexit exacerbates these challenges, with the UK economy estimated to have lost $27 billion in export revenue since leaving the EU. Under these circumstances, it's essential for the UK to reassess its trade policies and build new cooperative relationships. Nonetheless, in an increasingly volatile world, balancing economic interests with political strategy remains a significant challenge for the UK and the rest of Europe. In 2022, over 16,000 small businesses in the UK faced a significant blow, ceasing their exports to the EU. The data revealed a troubling trend, with exports from small businesses falling by as much as 40%. While larger companies performed better, the overall trend of the UK's exports continues to decline. In this context, the trade war initiated by the Trump administration risks putting the UK in a position where it can no longer rely solely on Europe as it once did. The Trump administration also demanded that NATO member countries increase their defense spending to 5% of GDP, imposing significant pressure. If most of these funds are allocated to purchasing weapons and equipment, it would offer little benefit to either the EU or the UK economy. Meanwhile, the EU is grappling with its own financial difficulties, making stronger trade ties with the region increasingly unfeasible. As a result, much like other EU nations, the UK is now compelled to engage with China, an economy that is not only growing steadily, but also gradually distancing itself from the United States. Given this context, evaluating the UK's trade strategy becomes crucial. The United States remains the UK's largest trading partner, with trade volumes exceeding $100 billion. However, China is emerging as a key strategic player, ranking second among the UK's import partners with a total value of $56 billion. China is also known for supplying low-cost goods, which are essential if the UK seeks to mitigate the impact of US tariffs. Although UK exports to mainland China totaled only $21 billion, when adding Hong Kong's $10 billion, China collectively becomes the UK's second-largest market for goods, with a total of $31 billion. It's noteworthy that the UK's reliance on the Chinese consumer market is increasing, especially as China works to develop its domestic market and decouple from the United States. This evolving relationship with China is critical for the UK, as it seeks to secure its economic future in an increasingly complex global landscape. This situation presents a significant opportunity for countries like the UK, which need to diversify their trade and reduce their dependence on the U.S. By 2025, should the U.S. impose severe trade barriers on the U.K., increasing trade with China could become a crucial survival strategy. This shift is not coincidental, but part of a growing trend that is likely to intensify in the coming years. The UK is quietly undergoing a transformation marked by a strategic shift in its approach to global economic and political engagement. There is a clearer emphasis than ever before on trading and investing in ways that align with national interests. Notably, discussions about China's support for Russia have been overshadowed by other pressing economic concerns, such as the decline of the UK's automotive industry. Amid this crisis in domestic car manufacturing, the UK seems to be seeking assistance from Chinese electric vehicle (EV) companies. The UK automotive sector is showing clear signs of struggle. The historic Vauxhall plant in Luton, owned by Stellantis, is at risk of closure, reflecting similar issues across Germany. Production costs in both the UK and Europe. Energy costs in the UK and Europe are rising to unsustainable levels. Technology, especially in electric vehicles, is lagging behind China by several years. UK car production has fallen by 30% compared to the same period last year, marking the 9th consecutive month of decline. From a peak of 1.8 million vehicles in 2017, output has now dropped below 990,000 units in just 7 years. These challenges are compounded by U.S. America First policies, which under both the Trump and Biden administrations have encouraged reshoring of manufacturing to the U.S. This has driven up energy costs for the UK and Europe while adding pressure on local industries. In this context, Chinese involvement in Europe's automotive sector may become a last-ditch solution. 2025 is projected to be a turbulent year for the UK economy. Meanwhile, another front in the global tech war is unfolding, focusing on the semiconductor industry. The Biden administration continues to implement measures to curb the growth of China's chip industry, signaling that the chip war is intensifying. Beijing is striving to dominate the global chip market, producing chips for various industries from cars and computers to weapons and household appliances. In response, the U.S. has imposed restrictions on advanced chips and chip manufacturing technologies, particularly targeting companies like ASML and Tokyo Electron to prevent these products from reaching China. However, targeting legacy semiconductors has made China more vigilant. Currently, China controls over 30% of the global legacy semiconductor market, and this share is expected to grow to 39% by 2027. Many products using these chips, from TVs and electric vehicles to laptops, are predominantly sourced from China. China's growing dominance in chip manufacturing mirrors its capture of the solar panel market, achieved through cost reductions and increased production capacity. By 2030, China is projected to produce 50 million 12-inch wafers annually, surpassing the combined output of the US, EU, and Taiwan. China's robust growth has prompted the West, particularly the US, to impose trade sanctions to protect its competitiveness. These measures, including import restrictions and economic isolation of Chinese products, aim to rebuild domestic manufacturing capabilities. However, the effectiveness of these policies is uncertain as China continues to expand its global influence. According to Rhodium, semiconductor companies are hesitant to invest in the U.S. largely due to Chinese suppliers offering chips at 30% to 50% lower prices. This price gap is attributed to China's supply chain advantages, including lower energy costs and control over domestic mineral inputs. Even the cost of shipping minerals from China to the U.S. is much cheaper. In response, the U.S. may impose tariffs on older chips from China, potentially ranging from 50% to 200%. This is seen as the only way to protect domestic manufacturing, but it risks dividing the global market, creating two systems, one for countries that continue to trade with China, and another for those aligned with the U.S.'s increasingly protectionist policies. By 2030, electronics are expected to account for half of the total cost of a car, with electric vehicles using at least 3,000 semiconductors, including mass-produced chips. American consumers could face higher costs when purchasing cars due to the higher prices of domestically produced chips compared to those from regions like Asia. This could trigger a global tariff war, leading to two separate. As global trade shifts, two distinct markets are emerging, one engaging with China and another pursuing U.S. isolationism. The decline in U.S.-China trade has significant consequences, including China's reduced reliance on the US dollar and its decreased dollar-denominated foreign exchange reserves. China now holds a record low of $760 billion in U.S. Treasury bonds, a $37 billion drop. Even with potential bond price recovery, China is expected to either let these bonds mature or sell them, posing challenges for the U.S. economy. Reshoring production to the U.S. remains expensive, especially with the Federal Reserve's recent interest rate cuts and projections of only one or two more by 2025. The Trump administration faces the challenge of issuing more bonds despite rising borrowing costs. While G7 nations may continue as net buyers, global demand for U.S. bonds is likely to decrease as China strengthens bilateral trade with other countries. The U.S. Treasury yield curve is unstable, with both 2-year and 10-year yields rising, the latter exceeding 4.5%. This impacts U.S. bond market interest rates, where competition is intensifying as China issues its own dollar-denominated bonds. Demand for these bonds rivals that of U.S. bonds, challenging Washington's financing, especially as China can borrow U.S. dollars at lower interest rates. The bond market is shifting significantly. Chinese investors are increasingly buying Chinese government-issued dollar bonds to retain capital domestically, pushing their yields below U.S. Treasury bonds. Beijing uses this strategy to reduce capital flow to the U.S. and intensify global capital market competition. These changes are expected to become more pronounced by 2025 as Western countries ease U.S. sanctions and China aims to disrupt the U.S. dollar system. The global trade and financial landscape is transforming, creating increasing unpredictability. Leading up to the U.S. presidential election, analysts have debated the winner's impact on U.S.-China relations. However, many in China believe tensions will persist, regardless of the outcome. According to Beijing resident Lei, a broad consensus exists from policymakers to citizens that every U.S. administration, whether Democratic or Republican, aims to curb China's global rise, particularly economically. During Trump's presidency, tariffs were imposed on billions of dollars worth of Chinese goods, and a campaign was launched against Huawei. Under Biden, the tone shifted towards stabilizing communication, but U.S. policy toward China remained consistent, focusing on the Chinese technology sector through investment and export controls and tariffs. Chinese analysts predict that regardless of the election outcome, significant improvement in U.S.-China relations is unlikely. Experts agree that U.S. policy toward China is likely to remain unchanged. Yin Heng, a professor of international relations at Renmin University in Beijing, stated that the continuity of U.S. policy will overshadow any potential for major changes. J.Y. Canrong, associate dean at the same university, echoed this sentiment, saying that China will remain the U.S.'s main rival, with only tactical differences between administrations in the U.S., both Democratic and Republican. Experts believe a tough stance on China and trade matters will continue. Eswar Prasad, an economics professor at Cornell University, suggested that a victory by Donald Trump could exacerbate trade and economic hostilities, accelerating decoupling between the two nations. However, even Vice President Kamala Harris could implement tougher tariffs, a step Biden has already taken. Carlos Casanova, a senior economist at Swiss private bank UBP, noted that trade tensions between China, the U.S., and Europe will likely persist, with a bipartisan consensus emerging in the U.S. for tougher measures against China. Recent surveys show that over 55% of Americans are unaware of the impact of trade with Asia, including China, on job creation. Only 30% believe that trade with China has created jobs in their state, and only 25% consider trade with Asia beneficial. Most Americans see trade as a zero-sum game, believing that other countries benefit more, particularly in the case of China. Experts predict that during the next presidential term, U.S. economic policies toward China will remain firm, focusing on tariffs and efforts to restrict China's high-tech sectors, such as semiconductors and artificial intelligence. The main differences will lie in the methods employed, with Democratic administrations favoring targeted measures, while Republicans may adopt more aggressive approaches. Chinese experts, such as Jin Canrong, acknowledge that U.S.-China relations have entered a phase of comprehensive competition, with confrontation becoming inevitable. As a result, China must continue to strengthen its domestic manufacturing sector, particularly in high-tech fields, while promoting the Belt and Road Initiative to secure a proactive strategic position in its rivalry with the U.S. During Trump's presidency, China took steps to prevent trade tensions from escalating. But, according to foreign policy experts, Beijing is expected to respond more assertively in the coming U.S. presidential term. One potential response could involve imposing heavy sanctions on select U.S. Fortune 500 companies, particularly in sectors where China can provide alternatives. Additionally, China might expand restrictions on critical mineral exports and implement other export controls. Beijing could also sell off a significant portion of its U.S. Treasury bonds, which it currently holds. However, the most impactful move might be allowing its currency to depreciate further, which would directly undermine U.S. tariffs and complicate Washington's efforts to weaken the dollar and reduce trade deficits.